You've been taught a lie about the most popular indicator in technical analysis. It's a deception so widespread, so deeply ingrained in trading literature, that it accounts for a catastrophic number of failed trades. I'm talking about the Relative Strength Index, or RSI, and the flawed, simplistic concept of overbought and oversold. Today, we are not just going to challenge this dogma. We are going to mathematically dismantle it, expose its core logical fallacy, and then, from the ground up, construct a superior, data-driven framework for using the RSI. This isn't about finding a new magic setting. This is about fundamentally re-engineering your understanding of momentum. By the end of this deep dive, you will see the RSI not as a simple reversal signal, but as a powerful gauge of momentum dynamics. You will have a systematic, verifiable method that separates you from the 95% of traders who are caught in the overbought/oversold trap. Let's enter the lab. First, let's perform a clinical dissection of the conventional wisdom. The standard textbook rule states, when the RSI crosses above 70, the asset is overbought and due for a pullback, signaling a time to sell. When it drops below 30, it's oversold and due for a bounce, signaling a time to buy. This sounds beautifully simple. It's also dangerously wrong. Let's look at the reality of a strongly trending market. Here is a chart of a high-growth tech stock during a powerful uptrend. The RSI crossed above 70 here and stayed there. According to the textbook, every moment it remained above 70 was an escalating sell signal. Selling here would have been a mistake. Selling here, a bigger mistake. And selling here? A catastrophic exit from one of the most powerful trends of the year. You would have been fighting a freight train with a pop gun, bleeding capital at every failed attempt to call the top. The overbought condition was not a signal of imminent reversal. It was a signal of immense, sustained buying pressure. So why does this fallacy persist? It stems from a fundamental misunderstanding of the RSI's mathematical architecture. The RSI calculation, developed by J. Wells Wilder, measures the magnitude of recent price changes to evaluate speed and change of price movements. The formula essentially compares the average gains on up days to the average losses on down days over a specific period, typically 14 bars. A high RSI value, like 80, simply means that the average gains have been dramatically larger than the average losses. It is a mathematical statement of fact about past momentum. It is asterisk not times a prediction about future price. Calling an asset overbought because its upward momentum is strong is a logical paradox. It's like saying a rocket is overflown simply because it's successfully achieving escape velocity. The strength you are measuring is the very reason the trend is likely to persist. Trends are defined by sustained periods of one-sided momentum. The 70/30ths levels are arbitrary lines in the sand that have no statistical predictive power on their own. They are relics of a time when markets were perhaps less momentum-driven, but in today's algorithmic landscape, they are a trap. Now that we've dismantled the flawed model, let's build the correct one. We must stop thinking about absolute levels and start thinking about relative change. The true power of the RSI lies not in its value, but in its relationship with price. This is the concept of momentum divergence. Divergence is a discrepancy between the action of price and the action of a momentum indicator. It's a warning sign that the conviction behind a price move is fading. The engine driving the trend is beginning to sputter, even if the vehicle itself is still coasting forward on inertia. Let's define the primary, most powerful form: regular divergence. It comes in two flavors: bearish and bullish. First, regular bearish divergence. This is our high probability setup for potential short entries or profit taking on long positions. The conditions are precise and non-negotiable. 1. Price makes a new, higher high. This is critical. The crowd is euphoric, chasing the price to new levels. We can see a peak here, a pullback, and then a new, higher peak. 2. The RSI, over the exact same period, fails to make a new high. It makes a lower high. What is this telling us? It's a profound piece of information. The second push to a new price high occurred with times less times momentum, with times less times force, than the first push. The buying pressure is becoming exhausted. While the amateurs are buying the new high, the strategist sees the underlying weakness. The foundation of the trend is cracking. This is not a blind sell signal. It is an alert. It's the yellow flag in a race. It tells us to stop analyze, and prepare for a potential change in direction. Now for the inverse. Regular bullish divergence. This is our setup for potential long entries. 1. Price makes a new lower low. The sentiment is bearish. Fear is in the market as sellers push the price down to a new bottom. 2. The RSI, over the same period, makes a higher low. Let's dissect the logic. The drop to a new price low was accompanied by less downward momentum than the previous drop. The selling pressure is abating. The panic is subsiding. While novice traders are panic selling the new low, the data is suggesting that the sellers are running out of steam. This is often the environment where smart money begins to accumulate positions. This is a universe away from the simplistic RSI is below 30 so I should buy mentality. The divergence model is dynamic. It respects the trend, but it also provides a quantifiable reason to suspect the trend's exhaustion. However, a signal is not a strategy. A raw divergence pattern is a piece of evidence, not a verdict. To trade this effectively, we must build a systematic framework around it. This is where we move from analyst to strategist. Here are the components of a robust divergence trading system. Component 1. Precise identification. We need strict rules. For a bearish divergence, we are looking for a new price high within a defined lookback period, say 20 to 30 bars, where the corresponding RSI peak is lower than a previous RSI peak within that same window. The peaks on the RSI should ideally be above the 50 level, indicating the prior move had meaningful momentum to begin with. Component 2. The confirmation trigger. This is arguably the most critical step that most traders miss. A divergence can form and persist for a long time in a stubborn trend. We do not enter a trade simply because a divergence exists. We wait for the price itself to confirm the momentum's warning. What constitutes confirmation? It can be a number of things. A break of a key short-term trend line is a classic. Once price violates the very line that was supporting its ascent, it confirms the momentum shift is now translating into price action. Another strong confirmation is a clear bearish candlestick pattern forming at the second peak, such as a bearish engulfing bar or a pin bar. This signals an immediate shift in the order flow at that critical price level. A moving average crossover can also be used. For example, a short-term moving average, like a 10-period EMA, crossing below a slightly longer-term one, like a 20-period EMA, after the divergence has formed. Your confirmation signal must be objective and non-discretionary. Component 3. Disciplined risk management. No strategy is effective without rigorous risk management. Your stop-loss placement is not an afterthought. It is part of the setup. For a bearish divergence trade, the logical place for a stop-loss is just above the highest price peak of the pattern. Why? Because if the price breaks above that high, our entire thesis is invalidated. The upward momentum was not exhausted. It was simply pausing. By placing our stop there, we are admitting our hypothesis was wrong and exiting the trade with a small, defined loss. This prevents a strategic error from becoming a financial disaster. Component 4. The exit plan. Equally important is knowing where to take profits. A profitable entry is useless if you give it all back. Your take-profit strategy should also be defined before you enter the trade. One method is to target a significant prior support or resistance level. Another is to use a fixed risk-to-reward ratio. If your stop-loss is 50 points away from your entry, you might set a take-profit at 100 points, aiming for a 1-to-2 risk-to-reward ratio. This ensures your winning trades are meaningfully larger than your losing trades, a cornerstone of long-term profitability. A third method is using a trailing stop, such as an average true range-based stop, to allow the trade to run as long as the new downward momentum continues. So let's assemble the system. Rule 1. Identify a clear, regular bearish divergence, where price makes a higher high and RSI makes a lower high. Rule 2. Wait for a confirmation trigger, such as a break of the immediate trend line. Rule 3. Enter a short position on the confirmation signal. Rule 4. Place a stop-loss just above the highest price peak. Rule 5. Place a take-profit order at a predefined target, such as a 1-to-2 risk-to-reward ratio. This is a complete, logical, and testable trading idea. It transforms the RSI from a guessing game into a strategic tool. Now, we must address the nuances in our lab session. No system is a holy grail. Divergence trading has its own specific challenges you must be prepared for. First, false signals. In an exceptionally strong, parabolic trend, you may see multiple divergences form before any significant reversal occurs. The trend can outrun the indicator's warning for an extended period. This is precisely why the confirmation trigger is non-negotiable. It acts as our filter, keeping us out of trades until the price itself validates our thesis. Second, there is a counterpart to regular divergence known as hidden divergence. It's a more advanced concept, but essential for a complete understanding. While regular divergence signals potential trend primes reversals, hidden divergence signals potential trend times continuation. A hidden bullish divergence occurs in an uptrend. Price makes a times higher times low, but the RSI makes a times lower times low. This indicates that the pullback was a healthy consolidation, and the underlying momentum is still strong, presenting a potential buy the dip opportunity. It's the inverse for a hidden bearish divergence in a downtrend. Understanding both types prevents you from misinterpreting a continuation signal as a reversal signal. Finally, and most importantly, context is king. The most powerful divergence signals are those that occur at a location of confluent technical significance. A bearish divergence is a good signal. A bearish divergence forming right at a major historical resistance level on high volume with a clear candlestick reversal pattern, that is an A+ setup. Your job as a strategist is not to trade every signal the system generates. It is to identify the signals that have multiple, independent layers of evidence supporting them. Don't take trades in a vacuum. Integrate the divergence signal into a broader analysis of market structure. So let's bring it all together. We have systematically proven that the conventional overbought/oversold RSI strategy is a flawed relic that fails in the face of strong trends. It encourages traders to fight momentum, a battle they are destined to lose. By reframing the RSI as a tool for gauging momentum dynamics, we unlocked its true potential through the concept of divergence. We then constructed a complete, logical trading system around this concept, with non-negotiable rules for identification, confirmation, risk management, and profit-taking. This is the level of analytical rigor required to succeed in the markets. It's about moving beyond simplistic rules and building a deep, nuanced understanding of why a tool works and how to deploy it strategically. Stop being a victim of the indicator's misuse. Start thinking like a strategist. Build your system, test it, and execute with discipline. If you're ready to discard the hype and build a truly systematic, data-driven approach to your trading, then subscribe to TradeLogic Lab and activate the notification bell. We're dedicated to decoding the market's logic, one strategy at a time. In our next video, we'll be pressure testing the MACD indicator, exposing a common flaw in its crossover signal, and re-engineering it for high-probability trend trading. You won't want to miss it. Stay disciplined and stay logical.